You ever look at a stock price and just wonder, what is that number really telling you? Well, today, you get to be a financial detective. We're on a case to uncover a company's hidden value, and our first clue is the one big question that every single investor asks themselves.
And that right there, that's the central mystery, isn't it? Is the price you see flashing on the screen the real price? Or is there something deeper, a more fundamental value hiding just beneath the surface? That's exactly what we're here to find out.
So on one hand, you've got the market price. Think of this as the daily chatter, the noise. It's driven by headlines, by emotion, by what everyone else is feeling that day. But on the other hand, you have the intrinsic value. Now, this is the truth of the business. It's the real deal. It's actual ability to make cold, hard cash over time. Our job as detectives is to tune out all that noise and find the truth.
Okay, so how in the world do we find this intrinsic value? Well, every good detective needs a specialized tool, right? Ours is, it's kind of like a financial time machine, and it's called discounted cash flow, or DCF for short.
At its heart, DCF analysis lets us do something pretty cool. It lets us travel into a company's future, gather up all the cash we think it's going to produce, and then bring all that cash back to the present day to see what it's worth right now. It is genuinely one of the most respected ways to figure out what a company is fundamentally worth. Now, the whole thing is built on one super simple but absolutely critical idea. It's this: a dollar today is worth more than a dollar tomorrow. And why is that? Well, think about it. A dollar in your hand right now, you can invest it. You can make it grow into more dollars. A dollar you might get next year, it's just a promise. It doesn't have that power yet. And that single concept, that's the key to the whole machine. All right, let's pop the hood on this DCF machine and take a look at the blueprint. I know it might sound complicated, but it really just boils down to 3 key steps. First up, we got to put on our fortune teller hat. We need to project or forecast how much cash the company's going to make over, say, the next 5 or 10 years. Second, we have to account for risk with something called a discount rate. And finally, a good company doesn't just stop existing after 10 years, right? So we have to estimate its value for all the years after that. This is called the terminal value. It's basically our way of capturing the company's worth forever, assuming it'll grow at a nice, steady rate.
So what exactly is this discount rate? I absolutely love this analogy. Just think of it as a risk tax. If you're forecasting cash from a super stable, predictable company, the tax is pretty low. But if it's a risky, unproven venture, oh yeah, you're going to apply a much higher tax to that future money just to account for all that uncertainty. Makes sense, right?
So, we've projected the cash, we've applied our risk tax, and now it is time for the big reveal. This is the moment where all of our detective work pays off, and we finally get an answer to our mystery.
We take all of those future cash projections, after they've been shrunk by our discount rate, and we just add them all up. The number we get at the end, that is our best estimate of the company's intrinsic value. This is our moment of truth.
And this is where the rubber meets the road. We take our calculated DCF value and we compare it to the current market price. If our number is higher, the stock might just be a bargain. It could be undervalued. If our number is lower, well, the market might be getting a bit too optimistic, and the stock could be overvalued. Case closed? Well, almost. Now, before we wrap up this whole investigation, there is a crucial final chapter. You see, every good detective knows the limitations of their tools, and DCF is no different. You gotta know what it can and can't do. So here's the crucial thing to remember. DCF gives you an estimate, not a fact. It's incredibly sensitive. A tiny change in your prediction for growth can lead to a huge change in the final value. It's fantastic for stable, predictable businesses, but it's not so great for volatile ones. So think of it like a powerful flashlight, not a magical crystal ball. You should always use it alongside other investigative methods. And that leaves us with one final thought. Since any valuation is really just built on assumptions about an uncertain future, the real art of investing isn't just about crunching the numbers, it's about making the most intelligent assumptions you can and really understanding the story behind them. And that, well, that's a whole other mystery for another day.